This week, the market absorbed a criminal investigation into the Federal Reserve chair and still hit new all-time highs. If you think that's normal market behavior, you're missing the deeper system at work. I'm going to show you exactly why this happened and how disciplined investors exploited the chaos while others panicked. When the DOJ announced their investigation into Jerome Powell, the Dow initially dropped 500 points. Pure fear response, the limbic system overriding rational analysis. But within hours, buyers emerged. This wasn't irrational exuberance, this was calculated opportunism. Smart money recognized that structural forces outweigh headline risk. Earnings momentum, liquidity conditions, and positioning matter more than political theater. The inflation data triggered relief rather than celebration. Core CPI came in at 2.6%, below the 2.8 consensus. Market participants had anchored expectations around worst-case scenarios after the government shutdown disrupted data collection. This is confirmation bias weaponized. Traders found the data point that validated their bullish positioning while ignoring the stickiness in services inflation. Here's what the crowd missed while fixating on headlines. The market structure absorbed political shock through volatility compression, not expansion. The VIX actually declined to 14.49 while the Fed chair faced investigation. This reveals a regime where liquidity provision overwhelms uncertainty pricing. Dealer positioning and systematic strategies created a mechanical bid that stabilized indices within hours. The sector rotation tells the real story. Consumer staples, industrials, and materials led while technology lagged. The Dow outperformed Nasdaq for the week, breaking 3 years of growth dominance. This wasn't random, it was multiple compression fears and AI-exposed names trading at 33 times earnings versus the Dow's 24 times multiple. JP Morgan beat earnings on both lines yet fell 4%. This disconnect reveals forward-looking anxiety about net interest margin compression and regulatory uncertainty around the credit card rate cap proposal. Investors are pricing in second-order effects before first-order impacts materialize. Meanwhile, housing stocks surged on sentiment rather than fundamentals. Leonard jumped nearly 14%. This demonstrates how narrative can temporarily override valuation discipline when policy signals shift. The semiconductor upgrade cycle from KeyBank provided fundamental justification for what was already a technical setup. Intel and AMD are sold out through 2026, creating supply constraints that support pricing power. The market's initial skepticism of Intel's turnaround created the valuation dislocation that this upgrade exploited. This is how inefficiency manifests. Information exists, but consensus positioning lags recognition. The bond market's muted response reveals either complacency or sophisticated understanding that institutional independence persists regardless of investigative theater. The 10-year yield held 4.18% with a steepening curve. Fixed income participants are pricing 2 rate cuts by mid-year, while equity markets price earnings growth acceleration. Here's the stoic interpretation that separates disciplined investors from the emotional crowd. This week demonstrated that markets are anti-fragile systems that gain from disorder when underlying structure remains intact. The Powell investigation functioned as a stress test that revealed resilience rather than fragility. Participants who panicked at the open transferred wealth to those who recognized the event as noise rather than signal. The intraday reversal from 500-point decline to new highs represents the market's clearing mechanism functioning as designed. Liquidity providers absorbed panic selling and redistributed risk to longer time horizon participants. The sector rotation into cyclical value represents mean reversion asserting itself after 3 years of growth concentration. The Dow's composition positions it to outperform if earnings growth broadens beyond technology. This isn't prediction, it's probability assessment based on valuation spreads at historical extremes. The credit card rate cap proposal introduces regulatory risk that cannot be hedged, only avoided or accepted. The immediate repricing in payment networks reflects rational adjustment to reduced expected cash flows. The disciplined response is position sizing that accounts for policy uncertainty as a permanent feature. Those who demand certainty will remain underinvested. Those who accept uncertainty as the price of participation will compound capital. The week confirmed that volatility is the cost of returns, not a signal to exit. Patient capital earns the volatility premium that impatient capital pays. If you value systematic thinking over emotional reactions, subscribe for frameworks that exploit human predictability. Download the complete Stoic Exploiter methodology in the description. It's designed for investors who choose discipline over drama.